and he's from Arizona, a CBOE trader. We'll get to him in a second, but it's an interesting time. Dmitry and I, this is East Coast time. It's 8 o'clock for us.
Yeah.
So for those people who are on, you can type where you're from in the chat, which is down at the bottom. My name's Will McBride, and I'm from Bucks County, Pennsylvania. I mentioned Jay Soloff. He's in the middle from Investor Alley, and he's from where in Arizona are you from? Tucson?
I'm in Gilbert, which is a Phoenix suburb.
Phoenix suburb. And then you have Dmitry Pargamanik from Philadelphia. Love Philly.
Center City.
Center City.
My brother went to Penn, actually.
Oh, did he?
Down in Boulder, Colorado.
Simon from Oregon. All right, people are joining. So before we get started, we're going to be talking about some different things. I just flicked the disclaimer behind me to remind it. I'm going to share my screen real quick. There's a disclaimer that everyone can see. Neither Market Chameleon or Investor Alley are registered investment advisors or broker dealers. So basically, take everything we say as with a grain of salt. It's not a recommendation. It's just our ideas and how we use the Chameleon and how Jay looks at. Well, today we're going to be talking about butterflies and iron condors. So just if you do have questions, consult a registered investment advisor. Anything you want to say about the disclaimer, Dmitry?
Yeah,
What's up there?
Or your broker, registered advisor, or your broker.
Broker, yep. All right, I'm going to stop sharing now. Again, people, questions and answers are down at the bottom, the Q&A. Leave your questions there. At the end, we will get to them. And as we go through, if I see anything pops up that's completely relevant with what Jay's talking about today, I will let him know and we'll try to answer it while he's on the screen. With that, Jay, are you ready to go? What do you think?
I'm ready to go.
All right. This is Jay Soloff, everybody. CBOE trader. He does a podcast, twice a week, Coffee and Condors.
Yep.
He has a subscription service. He's an educator, just an all-around great guy and trader. So there you go, Jay.
Thanks, Will. So most of you guys, if you've been with me, if you've been to any of my presentations, you're probably familiar with Market Chameleon because I use it pretty much for everything I do. I use it for all my analysis. I do everything in there except enter the actual trades because they're not a broker. So so you've probably seen the charts. You've probably heard me reference the site. So it's nice to actually have the guys from Market Chameleon here to be, so for us all together to work on this because, it's just been, like I said, I can't, since day one at Investors Alley, I've been using Market Chameleon and I can't really do my job without it. So it's very nice to have you guys here and to talk about some of what I'm doing. And also I have my Market Chameleon mug, which is quite stylish and goes well with it actually matches the back of the conference room that I'm supposedly in right now. So
that is a nice conference room and a beautiful mug.
So I'm gonna share my screen. We're gonna look at Market Chameleon because I want to talk about butterflies and condors, and I want to show what I'm doing in Market Chameleon at the same time because really, again, when I'm looking at anything, I'm looking in here anyways. You might as well look over my shoulder and see what I'm doing while I'm doing it. Now, a few things about both butterflies and condors. There are 1 million and 100,000 plus ways to put on both butterflies and condors. There are so many ways to use these trades. I'm going to talk more specifically about how I use them. Certainly doesn't mean that if you find other creative ways to use them or you're more comfortable doing certain things with them. I basically use iron condors for more neutral range-bound trades. I use butterflies actually for directional trades, even though a lot of people use them for more neutral trades. And I'll show you a little bit of what I'm talking about, but there's no right or wrong way with this stuff. I mean, use what you're comfortable doing, right? If you've had success using iron condors to bet on movement, that's not wrong, right? What's right is what works for you. So I want to say that, from the start. So that being said, let's start. I'm going to look at butterflies. So I'm just going to bring up a stock here. Let's use Twitter since it's right in front of me. And I'm going to go to the prices, to the option chain, so we can work from there. So let's go about a month out. Let me go to the July expiration just so we have a little bit of time. So with butterflies, there are all different types of butterflies, right? There are basically neutral, there are directional, there are call and put butterflies, there are iron butterflies, there are broken wing butterflies, there are unbalanced butterflies, right? So there's all different sorts of things you can do. We're going to focus on the more basic stuff here. But, once again, you also might hear different names for the same sort of thing. What's important is understanding the risk and return payoff for whatever strategy you're looking at, right? That's the stuff we're going to look at. We're going to look at how it pays off. So if you structure it a little bit differently, but it roughly pays off the same way, then that's fine, right? I mean, that's what, at the end of the day, it's the risk reward that matters. So I'm gonna start with the neutral butterfly because those are more common. I don't really use neutral market butterflies. I use iron condors for that because I think they're a bit safer, a little bit easier to use. However, I think it's best to start with the butterfly with the more common usage. So if you think that Twitter is going to stay in a range, for instance, then a butterfly might be a good trade for you. Now, if you're talking to a professional trader and you're saying, all right, I think Twitter's going to stay in a range, what would you do? They might say something like, well, I'm going to sell a straddle. All right. And that is probably the most pure way to bet on either a drop in volatility, or for short term, it's more of just a drop in movement. All right. But we being, pretty much, anybody here involved in this, including myself and probably Will and Dmitry, we're not selling straddles, right? It's an extremely expensive thing to do because you need a massive amount of margins. Most brokers won't even let you do it. You have to have whatever their highest level is and, an absurd amount of cash. And it's not a very practical trade. Professionals who sell straddles will be delta hedging it probably daily or multiple times a day. So it's not the sort of thing that you do as a position trade, if you're not a professional trader. So what's the next closest thing you can do? Well, a butterfly, right? Because basically you're selling a straddle and then you're just putting some strikes around it to protect yourself and to lower your margin. All right. So if we're at, where are we? 36, 37, let's just say 37. So if we think that Twitter's not going to go anywhere or not go that far from 37, selling the straddle would be selling the call and selling the put. All right. Well, instead of doing that, we're going to do a butterfly. Now you could do an iron butterfly, which is using both calls and puts. I'm just going to do a regular old call butterfly to start with, just because it's probably the most basic trade. So we want to sell the middle here, and then we'll just do, we'll do 3 strikes in either direction just to see how that looks. So we'll buy a 40 call, and then we'll buy the 34. And this will make sense once I show the graph. And then since it's butterfly, we want to sell 2 of the middle. All right. So let's
wait, Jay, I think you did.
Oops. Yeah.
The middle is the other one.
Yeah. Right. Let's change this. There we go. All right. Buying the wings, selling the middle.
Well, I think you just wanted to make 2 of the 37, right? Like
I thought that was in the middle. Yeah. Good call. All right. So let's
sell 2 of those.
Make this one. There we go. And this will be I'm used to having the middle strike in the middle, but I did the 37 first, so it showed up first. So, all right.
Yeah.
This is
Jay, just so you know, Dmitry was my risk manager for 20 years. So every time something came into the system, I would get a buzz occasionally.
Yes.
The graph would have shown it, but
if I would have loaded up the graph, I would have known right away. I gotta get used to, it makes more sense to start at the bottom and work your way up if you want it to be intuitive, but I started with the middle. So that was, yeah, it's a good thing that, you know, I'm not trading and Dimitri's not my risk manager. He'd be really scared of me right now. So, all right. So, but this is what I wanted to bring up. This is the graph, the profit and loss graph. This is ultimately what's most important here. You have this range centered on 37, right? Because that's where we sold 2 calls. And then we have the end strikes of 34 and 40. That's our max loss. So when you're looking at a trade like this, we're looking at, where's our premium here? Strategy pricing. Oh, see right here, 78 cents. So, or the midpoint's about 67 cents. So let's say we get filled for 67 cents. That is the most you can lose on this. And that's what's great about a butterfly, right? You can't lose more than what you pay. And you can see right here, you have limited losses. So if we were just to do a straddle, and we can just show that if I were just to remove these points, doing this right, and then reload it, you'll notice that, what did I do? Sell 2 calls. Oh, I'm selling the call and the put. See, this is why I gotta get used to doing it this way. I'm used to, I've been doing something different. All right, there we go. Sell call, sell put. Now let's look at this because this will make a lot more sense. All right, so here's a straddle, right? Here's selling a straddle. You have that range component here, but then you have unlimited on either side. So this is not something, again, this is not something that we want to do because this scenario here where you have unlimited losses means your broker would never let you do it, right? Nor do you want to do it unless you're daily hedging, which is, again, not the sort of thing that, unless you're a professional trader, you probably don't want to sit in front of your screen all the time. So,
hey Jay, we do have a question from Stephanie.
Yeah.
She's asking, how are you choosing the strikes?
Yeah, that's a good question. So let me put this back on now that I'm getting more familiar with, I've been doing it in the strategy. I've been using this in the strategy. Let me start over. I've been using this in the strategy payout thing. I haven't been doing it from the option chain. That's why I'm a little bit slow on this one. So just bear with me. This is a much better way to do it. I just need to get used to doing it here. All right. So there's not necessarily a right or wrong answer here, right? What I'm doing is sell, buy. There we go. All right. So I'm using 3 strikes. I'm saying that it's basically, it's not quite a $6 range, right? It's more like something like a $5 range because you have to pay a certain amount of money for the trade, right? You have to pay 67 cents. I'm saying I'm setting the strikes based on what I feel is a reasonable range here, right? So, and there are different ways you could do it. I mean, you might be looking at volatility, you might be looking at a few things, but something like this where you can see what you're doing, it makes a lot of sense to kind of have an idea. You might be looking at the chart of Twitter and saying that, all right, well, it's been in this range. Now Twitter's been going basically straight up, so it's not a good example, but you might be looking back and saying, all right, well, Twitter's been 35 to 39 for a while. I want to give myself a little bit more room. So I'm going to use these, I'm going to do a little bit wider, right? But you could say, all right, well, you know what? Twitter's only been in a $2 range. So I'm going to go, I'm going to go quite a bit narrower. Yeah. 35 and 39. Right. So there's, so you could do it. You could change it as well. Right. And now you're only paying, 31 cents, but you have a much narrower range. Like everything else, it's a matter of risk and return, right? Like the risk in this case is how much you're spending. So if you're spending 31 versus 67, your risk is less, your capital risk is less, right? Because you're spending a lot less money. However, your chance to succeed is also a lot less because you only have this narrower range. So there's not a right answer. It's why I like to use iron condors, which I will talk about in a minute. What I do like to do though with butterflies is because you see the benefit here by selling the middle strike twice, you're saving a lot of money. You're saving a lot of money on premium. So let me show you how I like to use them. Let's just clear this out. So let's say I think Twitter is going, it's at 37. Maybe I think it's, maybe I think it's going up to 42 or something like that. So maybe I do like let's say we'll just do like a 38-42 call spread, right? So we're buying the 38. It's kind of expensive.
Jay, just someone's asking, what month are you selecting? Because they're saying
I'm looking at July. This is the July. There's not, again, that your time frame is based on your own. If you think Twitter's going to go up in the next month because social media is going to be going nuts because of all the protests going on, then you might say, all right, I'm going to do this a month out. If you think, that it's not going to go up until the next earnings come out, then maybe it's 3 months out, right? So, I mean, your timing is obviously dependent on your own time horizon. I'm looking at July 17th.
All right. Yeah, because Stephanie thought you were on June 8th. So she's like, that's pretty short, no?
Yeah, no, it's about a month. Most of my trades I try to do about a month out, but it obviously depends if there's an event involved, right? So,
cool.
So if I'm looking at, let's say I think Twitter's going up to 42, and I might want to buy a 38-42 call spread. Well, a 38 is kind of expensive. I don't want to spend $1.67 on that. All right, so I'll sell the 42, and now I'm spending about $1, right? A little bit over $1. So we have this. This is what a normal call spread would look like. You lose money up until your break-even point around 39, about $1 more than your lowest strike, because that's the cost of the spread. But then you're capped at about 42 here and then beyond that. So that's what a call spread looks like. But then you might say, well, shoot, I don't really think Twitter has that much more upside beyond 42. So or some area up here, you might say, all right, I think it's going to go up, but I don't think it's going to explode higher. And I really don't want to spend $1, right? That means that the most I can make out of this is I make $3. I'm spending $1, not bad, but I think, we can do better, right? So let's say instead we'll just keep the 42 as our strike since it's already in there. So let's say we'll sell 2 of those right here. And now, if we want to make an even butterfly, we'll go up to 46. I don't know if there's a 46 strike. All right. The flaw in this plan is that there's no 46 strike. So let's move this down to 41. Because I like having even. If it's not even, then it's a broken wing, which is perfectly fine. But that's not what we're discussing right now. So,
and this is also the great thing about the Chameleon, right? You can go through and play around with different opportunities that are in the market and kind of get something that fits best for you.
Right. Exactly. Yeah. And it's very easy to, so I noticed that I couldn't even do a 38-41 because there's no 44, but it's very simple. If I want to make this even, I just put this down to 37, 41, and then we can go up to 45. Right. So again, it doesn't have to be even, but it's much easier to look at the payout, to look at evenly spaced strikes. For educational purposes, it makes a lot more sense. If you do one of these at a different length, it becomes a broken wing. Nothing wrong with that. Just that for, if you're learning butterflies, it makes a lot more sense to space them out. And so you can very easily see the payout. All right. So same thing. All right. We make money as it goes up. We peak at 41. So remember we lowered this from 41 to 42. So now our peak is 41. All right. But then if we blow higher and we go past 45, then we can go back and but the difference, we can only lose the 76 cents we spent. All right. So the difference is here, we're only spending 76 compared to $1.05. Plus we have this huge range, right? So we have this range that goes from a little under 38 all the way up to a little above 44. Anywhere in this $6 range that it ends up, and you have the potential to make money. Now, the drawback of a butterfly for a directional trade is not necessarily that you can blow through, because if you're buying a stock, if you're trading Tesla or something that moves $50 a day or something crazy like that, you're not going to use a butterfly most likely. You'll use a vertical spread like we were looking at. So I'm not going to say I've had it. I've certainly had it happen where a stock is blown through my butterfly range, but it doesn't happen that often. Usually we're picking a stock that's volatile, but not that volatile. So that hasn't been a problem. What is a problem is that if you're aiming for this peak, it's almost impossible. You have to time it exactly to where it's at 41 at expiration. That should not be your goal. Well, it can be your goal. Personally, I don't think that should be your goal. Your goal should be, I want to spend as little as possible, get into this range and make a nice profit. I mean, you could easily make, multiple 100% sort of profits without hitting your peak, particularly now I had to move this down to 37 to make it fit. But if we were doing the 38, 42, 46, this probably would have cost us 30, 40 cents. You could have easily turned that into a couple dollars quite easily, and that's a huge percentage gain. So that's what I like about butterflies. You're not spending a lot. You're not risking a lot. It's a little more precise trade, right? So it's got to be done on the right type of stock. But I also like to use them. You can do put butterflies, right? So I also like to use them for hedges on indexes quite a bit. If I feel like there's a floor on how far an index is going to fall, like, I don't know if I do it right now where we're coming off a couple months from a crash, but in previous years, I've used butterflies for my hedges because I feel like there was a limited amount that the market was going to fall within a given month. Volatility was relatively low. So these trades are good ways to essentially make low risk directional bets. So a little bit more precise than a vertical, but cheaper. All right. I'm going to bring up iron butterflies. So Will, if there's any questions now while I reload a strategy here, can do that. Anything related?
Well, one of them was asking how you would compare a butterfly to an iron condor if you were going to look at the two of them against each other.
Gotcha. Yeah. We'll do that. I think it makes sense to look at an iron butterfly and then an iron condor. I feel like it's a pretty good progression. So I will get to that. We're going to look at an iron butterfly, which is very similar to, I mean, it's essentially the same thing as a call or put butterfly, but it uses calls and puts. For some people, it's more intuitive to look at a call spread and a put spread together, just like with an iron condor and a condor. The difference is you almost never see call or put condors. You almost always see iron condors. With butterflies, you'll see call butterflies, put butterflies, and iron butterflies. You'll see all three. But just since you'll hear the term iron butterfly, let me structure one around like that first one we were doing. We were selling the 37 call, and now we'll sell the 37 put. All right. So this is our short straddle, right? Well, in order, we want to cap that. So we'll go back to, I did a 40. We'll buy the 40 call, and then we will buy the 34 put. All right. This looks right. I'm getting the hang of it, Dmitry.
Yep. Looks good.
All right. You'll notice that this looks identical to that call butterfly that we started with. The difference is, and the big difference here is that you're doing this as a credit trade rather than a debit trade. The interesting part is the payout is the same, right? The difference is that instead of getting a debit that if it doesn't move will slowly become a credit in your favor, this one you're starting with a credit, and then if it moves away, that credit will go away. So it's just whether you get the cash up front or whether you start with a debit. There might be, depending on your broker, they might have an issue with doing it one way or the other. Maybe you need to do the debit in order to satisfy your broker. I don't know. Every broker's a little bit different. I don't know. I mean, Dmitry, do you have any experience with that? Do you think brokers care if it's an iron or a regular?
I don't know. You mean you mean like a iron butterfly or just like a call butterfly?
Right. Yeah.
I don't think brokers, I don't think they care, but like one thing to be aware of when you're doing a call butterfly is the dividend, because you're you're long a call. So when you're long a call and there's a next dividend coming up, you got to realize that the call, it's an option. You're not entitled to the dividend. To get the dividend, you have to, if it's deep in the money, you have to remember to
Yeah.
exercise that call. If you don't, you miss out on the dividend. The next day the stock will get adjusted and you're going to basically miss out. With this, you don't have the same situation. So you could use either or. They're going to be mirror images, but it's important to understand if you're doing call butterflies in a stock that has a dividend, you need to remember to exercise it the day before the ex-dividend. The other thing is just to be careful. If you have a stock you're long and you have long-term capital gains on it and you're doing a call butterfly, that could, whenever that, depending on your broker, you got to tell them, like, I don't know, they probably have a system first in, first out. You have to let them know, because that could trigger a taxable event, because it's going to look like you sold your stock when you get assigned on some calls, bought it back. It could trigger a taxable event. So when you're doing the call butterflies, just be aware of that situation, because you don't want to create a taxable event for yourself, and you don't want to miss out on a dividend, because that will show up as a real loss to you.
Right. Right. Yeah, those are excellent points. So that there's another, it's stuff I wouldn't have even thought of looking at the difference between iron and regular. I usually just look at it in terms of debit or credit, but that's an excellent point. You have the dividend risk, you have the taxable event type risk, but in terms of the payoff, though, you're looking at the same structure. Some people like doing calls and puts together. It's more intuitive to think of, all right, well, I'm selling a put spread here, I'm selling a call spread, they're both at the money. I think it makes even more sense with an iron condor, which we're about to look at, but just wanted to show you what an iron butterfly looks like. When I'm doing directional trades, for me, I'm doing all out of the money calls or all out of the money puts when I'm doing these directional butterflies. So to me, it makes more sense just to do either all calls or all puts and not use iron. But iron, I think, is a lot more common for the neutral type of butterflies. But
Dmitry, not the King Chameleon, but Dmitry in the chat, this is another Dmitry, is asking, this is a short vol trade, correct? Would we need to be careful about rising IV in this situation?
It's a short vol trade, but really it's a short gamma trade. So, and I don't want to confuse, I don't want to confuse people. So, in July, to some extent, you are exposed to volatility, but your volatility exposure tends to be in longer term options. When you're dealing with shorter term, it's more gamma, which is not that different in essence. It's not that different with volatility. So movement versus, gamma versus vega, it's kind of a short-term movement versus longer term. So, but yes, essentially it is a short volatility trade, right? It's because you're worried about movement. Now, however, it's potential that you could have something that moves up and down in a range a lot without ever breaking out. And so maybe its volatility looks a little bit higher, but it still makes for a good range bound trade. So that's where it's kind of like a little, and that's a little harder if you're just looking at the numbers without looking at the movement of the stock. You might say, all right, well, this is high volatility, I don't want to mess with it. But then you might look at it and it's Twitter going from, 35 to 39 over and over again for a year. And you're like, oh, wow, this is a perfect, butterfly condor trade or whatever it might be. So that's where you have to kind of look at different pieces and decide whether it makes sense. So, but yeah, that's a good question though. Generally speaking, short iron condors, short, butterflies where you're short the middle, those tend to be short volatility. So let's look at an iron condor, which is basically the same thing, except we're doing a wider range. We're doing an out of the money call spread and an out of the money put spread. To me, if I'm doing a neutral trade, a range bound trade, I want to do a condor just because you have this bigger range that it can move in between. And I think it's just more intuitive because you're selling a call spread out of the money, you're selling a put spread out of the money. To me, it just makes intuitive sense. So let's look at, so Twitter again, we're here 37. So let's say we're going to sell, let me make sure we have strikes on both sides. Let's do like 39.42, and then I'll say 34.31. Okay. All right. So if we're selling a call spread, we're selling the 39, and then we would be buying the 42. All right. So that's one side, and then we'll go to the other side, and we will sell the 34, and then we'll buy the 31. All right. So this is selling a call spread up here. This is selling a put spread down here. And you put it together and we have an iron condor. So by the way, in both of these cases, the butterflies and the iron condors, they're named from the graph. However, the funny thing is that they're named from the graph when they're upside down, and those are both ways that you rarely see them done. If this was flipped over, it would look like a bird with long wings, like a condor. If you were, same thing with the butterfly where it's like this and it's got, but those are the ways that you don't really ever see them traded. Most of them are traded on the short side. So they're upside down. So it's really upside down condor, upside down butterfly, but that's where the names came from. So you can see that it has a similar structure to the butterfly, but instead of coming to a point here, it's this long range where if you're in this range, you get the, you know, the max credit, which in this case is about $1.35 if it stays in this range. If it drops out of the range, there's the max that you can lose on either side. So it caps your loss. It's got a max gain that covers a large range, right? So as long as you stay in this range, and to me, I like these. It's just, I think it's much easier to say, all right, I think, you know, Twitter's going to stay in a $5 range than going to stay in a $2 range, right? Butterfly may make more sense for a cheaper stock, right? If you're dealing with a stock that's about $10, all right, well, maybe you don't want to do a Condor because the options aren't going to even be worth that much when you get far away. So there, a Butterfly may make more sense. But I think really with most stocks, if you're trying to trade a range or a neutral, you'll have more success with the Condor just because it's less stress, right? You have this long range and you have time for it. If it starts moving up to one side, you're like, all right, well, maybe I should close the side, or maybe I should buy another call to hedge myself, or something along those lines. Sorry about these graphical glitches. I think my computer is. Well,
they look all right on my end. I don't
okay,
know.
Good.
Jay, I did have a question coming in from Venka. They're asking what deltas, like you're selecting the strikes. Do you even are you looking at the deltas?
Yes.
What deltas are you selecting and why?
That's a great question. And for this, I was just looking at strikes, but when I'm putting these on for money, you know, I look at delta. And my personal experience is I've had the best success selling 15 delta options on both the put and call side about a month out. And then I'll do my spreads usually 4 or 5 wide, depending on what my credit is. So I tend to stick to the 15 delta. I think anywhere between 10 and 20 is reasonable. I think when you get up to 30, it's too risky. You know, there are times where you can find stuff that maybe 5 or 10 delta that you can sell if it happens to be a particularly volatile instrument. But my sweet spot has been 15 delta. But there's not, this comes back to risk versus return. There's not a right answer for this. You know, there are people who will swear by selling, 30 delta options every 2 months. And there are people who will swear by selling 5 delta options every week. Right. So you got to kind of figure out what you're comfortable with, what will allow you to sleep at night, and where you feel like you're getting a credit. I like to get, you know, if I'm doing a trade for about a month and I can get about $1 credit out of it without putting on too much risk, that's kind of a goal I'm shooting for. That way, if I want to close it early, I might be able to take 50 cents out of this credit in a week and close it and say, you know what, I'm happy with that. I've made my 50 cents in 1 week and I can move on to something else. So I tend to, I tend to look for certain levels of credit. Again, it depends on volatility, depends on the market environment. This is the part where experience really plays in, right? You want to try different things and kind of feel what you're comfortable with. And of course, you know, the beautiful part in Market Chameleon is you can mess around very easily with changing these strikes, or maybe, you know, bumping up volatility and seeing what that'll do, or hedging it. What if you want to throw in some shares to hedge yourself if you're worried about it? So that's the part that it's great. I mean, if the more flexible your analysis software is, the more flexible that software is to let you change the scenarios, the easier it is. I didn't even get into some of this other stuff because Chameleon has so much great stuff. I don't even get to mess around with it. But I mean, you can kind of look at how this is done historically from a premium standpoint. And I don't know about this.
Jay, do you happen to use Thinkorswim as a platform by chance?
I do. Yes.
We have Dave is asking, or excuse me, it's Reg is asking, when you enter it, does it require 2 transactions, first the call spread, then the put spread, or
not in Thinkorswim? In Thinkorswim, there's actually an iron condor choice, but now that commissions are so low, you could easily put this on as a call spread and then a put spread. It used to be that you want to put it all at once because you wanted to save commission costs. That's not the case anymore. Now that commissions are so cheap, if you feel like legging into a spread is easier for you to do and easier, you don't have to worry about doing it all at once, by all means, do a call spread and a put spread. The only thing you can't do is do the short part first and then the long part, because your broker will freak out. You can do the long part first and then the short part. But anyway, so that's the introduction here to basically butterflies and iron condors. But what I want to show you is that a lot of people, we're already getting a lot of questions. How do you determine this stuff? How do you find strikes? How do you pick months? Well, the beautiful thing here is that Chameleon actually has screeners for all these different things for iron condors. And like I said, like regular condors don't ever trade, right? I mean, they're not, I don't think I've ever seen a regular condor trade in any size in the market. You'll see iron condors, you'll see the rest of these trade. Large blocks of them will actually happen. I saw 40,000 by 80,000 by 40,000 call butterfly in SLV just a couple weeks ago. 40,000 lot call butterfly. So these things trade. These things are used by professionals. So what's nice about and I use this for sure. If I have some stocks that I'm watching, but then if I'm looking for an idea, you could easily come to these screeners and start kind of narrowing down the field of things that you're looking at. So this was a short iron condor like we were just looking at. So you can do it by price of the stock. You can do it by stuff, what has it had earnings or not. So if you like just trading ETFs, or you can do it here based on, order flow sentiment. I mean, there's so much here that I haven't even messed with.
Well, while you're on the screener, Dima, maybe you can help guide Jay, because we have a question popping up from Richard. He's asking, does the system show when you're screening here the success probability or the win rates, or is there something you recommend?
Right. Yeah. So the way, and I think somebody else kind of asked a similar question, like how do we help with determining which butterflies to do and kind of like how to select the different legs in the butterflies. And one of the things that we do is, of course, and if you went back to the to the options chain, when you're doing a butterfly like Jay was showing you, a butterfly itself is looking at movement, right? You're not really selling Vega as much as you're looking at the movement of the stock. You want it to sit there. You want vols to come in or just decay, right? And so what do we look for then? If we don't want movement, there are 2 things that could cause movement, right? Things that we don't know about, so we can't anticipate, and things that we can anticipate, such as like earnings or or any type of event like a conference call or something that's going on in the stock. So if you see over here, Jay was on July 20th, but we see that July 24th, you see that little E, that's an earnings. So that's just kind of letting you know these are certain events that we already know are going to be happening, and you might want to stay away from events, or you can do the events if it's very richly priced. but you have the ability to analyze that. So when you're betting on movement, one thing you want to first check is there anything coming up that could make the stock move? And you want to make sure that you're taking all that into consideration. It's a biotech stock, it has a phase 1 trial in her, what, PDF, you want to know that ahead of time. Of course, anything could cause a movement. We don't know. Tomorrow the CEO could say something really bad that we can't anticipate. So the other thing when we're looking at the options are statistical instruments. So once you set up the Butterfly, obviously you've got some kind of an opinion where the stock might be at, right? Like Jay was showing you, he kind of did it where maybe the stock will just sit right around the current strike, or you could create a target price based on your opinion, or you have some statistics right here in front of you to help you out with that, like what does usually happen. So when we look at stock prices themselves, you got to remember that stock prices are like a coin flip, they're random. What does random mean? We don't know if it's going to go up or down, right? We can't predict tomorrow if it's going to go up or down, but what kind of math do we use in randomness, right? We use statistics, just like a coin flip. It's random. I don't know if the next thing is going to be a heads or tails, but what I can figure out is it's 50-50, right? I could know my odds of success. That's how we apply options and stock trading. So here, obviously, a stock doesn't exactly act like, it's not a coin flip. A coin flip, the only thing that could happen is either head's going to come out or tails, 50-50. But a stock is different. It could be anything. It could be, I don't know if Twitter's going to be tomorrow, up $10, down $10, up. So we don't really know for sure. It could be any kind of result, but we use historical outcomes to kind of get an idea. Well, how likely is something going to happen, right? Like how likely is it going to go to 0 tomorrow, right? Probably very little. It hasn't happened. It could. And so we start figuring out statistics based on that historical stock behavior. So if you see over here, right above the options chain, I can't move my screen, but you see here, like we'll show you how the stock usually drifts in that this has 33 days to 33 trading days to expiration. So we know that historically over the last 6 years that the stock has drifted higher 56.7% of the time. 56.7% of the time it's been higher over a 33-day period. Any given 33-day period, it tends to drift higher, an average return of 4.5%. So that's how we start using historical statistics to help us carry what are likely scenarios. We see that the most it's moved up over that period is 18.9%. The worst it's 30.5%. I'm sorry, the best is 65.2%. Worst is 30.5%. We see on average an up move and down move. So we start using that and applying that to help ourselves out with choosing the legs. And it's very important. If you're not doing it, then you're just guessing, and of course, if you're a good guesser, no problem. Or if you have a really good idea why it is, if you have a good analysis, then of course you could apply that to your iron condor. If not, then at least as traders, we look a lot at, the numbers, statistics, and see from a historical perspective how likely it's going to happen. So what I mean by that is, like, even if I know the probability of let's say a coin flip, it's 50-50. But if somebody tells me, hey, if I flip this coin and it lands on heads, I'll pay you $1.10. If it lands on tails, you pay me $1. Of course, I could lose, but statistically, it's better for me in the long term, I would take the heads because it pays off more. Does that make sense? Even though I could be wrong, all I'm doing is playing, from a statistical standpoint. That's what options are doing. So that's kind of like just a really quick scenario. So when we go to a screener, that's what the screener is helping you do. So let's go back to that iron condor screener. So somebody's asking, what's the success ratio, right? So this is what we're doing here. Like, so you see an apple, like the first one, you see that this iron condor right in the middle, you're selling the 330 put, buying the 312.5 put, selling the 337.5 put, call, buying the 355 call. So we go through that analysis for you and say, okay, right now the market price is $6.67. So you see that over there, Jay, $6.67 is the market price. Remember, you're selling it, you're getting a credit, right? We think based on the historical stock moves, right? If we go back and just do the same trade over and over, based on the historical stock moves, on average, this iron condor is worth $6.40. Remember when we were talking about the coin flip? So if on average it's worth $6.40, but I could sell it today at $6.67, that's my little bit of edge. Does that make sense? So of course, it doesn't have to behave exactly like historicals. We're using, like, I think 4 years in this situation or 6 years. So those are our best guidelines, right? Just like an insurance company, they don't know exactly, how many insurance policies are going to pay off, but they use their historical analysis to say, this is where on average it's been. So that's how they price it. So when we talk about the statistical, that's your little bit of edge. It's 2.5% edge. What's the success rate, the win rate, right? So if we sold this similar iron condor historically over and over and over again, $6.67, we apply those historical returns to it, and we say here, 61.1% of the time, this trade would have been profitable historically. That's your historical probability of profit. 61% of the time, right? So you see your edge, you see your win rate. Of course, you could sort by that and filter by that. And what it's doing is you could see right now, these are all Apple and June 19th. They're all in front of you. So now you could compare them. And I think somebody asked, how do you choose the best ones? Now you could compare them by their win rate and edge to filter out the best ones. Right. So, Jay, do you see that show best only? Do you see that filter?
Show best only.
You're right on it. You were right on it. Over to the right.
It's just to your right.
Oh, here. Yeah.
So drop that down. So let's just say we want to, in all our stocks, or you can do by your market watches, like show me the best one. I think do one by theoretical edge. Pick that first one.
Okay.
Theoretical edge. So it's the first one. So right now it's scanning the entire markets and showing you here in Apple, Microsoft. This is in June 19th expiration. That's so you could see that that's the, but even the best ones here, see some of them are negative. So you could go up to the theoretical edge, like right above that, Jay.
Yeah.
And just pick, like, you could pick, I need at least 10%. Let's just put like a 10%. So now it's going to scan for you, make sure that you get at least 10% edge. Again, maybe you want to even narrow it down more, and like you see the win rate right below that. So that's your historical probability of profit. Let's put 70%. So now that's scanning so by hand, you'll never be able to do that. That's how powerful,
Right.
You need machines, right? If you're trading at this day and age, you need machines, or you're going to be at a huge disadvantage, because this is crunching billions of data sets right now, billions of data sets really quickly for you. If you're trying to do it by hand, good luck, but you got to realize who you're competing with. And, by the time you might do this analysis, these options would have already expired. So you could see here right away, we see in Microsoft, here's one with 16.6% edge, 73.7% probability of success. Facebook, 12.5% edge, 74.2% probability of success. These are using actual returns, historical returns for you to filter these credit iron butterflies out. So then over here, you have your strikes, and you could quickly make decisions. And of course, you could go to options chain and analyze it further. But that's how quickly, you should be able to narrow down possibilities before you analyze it further. Hopefully, does that make sense? I was trying to answer like 2 questions there.
Worked for me.
Actually, I learned a few things there, so that was great, because I haven't, like I said, I haven't used, I've been doing things for my, I've been doing my own analysis for so long that, sometimes I forget that there's things I could easily automate in Market Chameleon that would have saved me a whole lot of time of, downloading it to a spreadsheet and doing it myself. So,
Yeah,
this,
exactly.
but
So the idea is let the machines, store the data, look at the data for you, crunch the numbers to help you out, right? That's the idea. Just like an insurance company has their machines, their data to help you out. So when, and I see more questions. I think those are for Jay.
Yeah, we have someone who's asking, can you show a directional butterfly example in the screener?
When you do a directional, right? So these always start out as a neutral trade. So when you do a directional, you have to start, first of all, which direction you want to go. You got to kind of start shifting your strikes, right? So if you're going up, you're shifting all the strikes up. If down, you're shifting them down. Probably from the options chain, Jay was showing it, but even if you do one, like if you want to set one up, like a neutral one, and just shift, there's like a little button, start shifting it up, you could show them. But that's kind of the idea where, you have some kind of target price, where you think that the stock is more likely to drift, and you shift those strikes higher.
Right. Yeah. It would be hard to create a screener because that's not really the edge in the butterfly is kind of based on the theoretical. When we're, I'm using the butterfly as a way to reduce costs on what would normally be a vertical call spread or vertical put spread, which I do think you have screeners for bullish and bearish type moves.
Yeah.
So I think in this case, you would do something like a bull call spread, or bear put spread. You would do a debit spread, and then you would say, okay, these are kind of expensive. I'm going to see if I can turn these into a butterfly. I think that would probably be better because I'm not using the butterfly in the traditional sense of, I want to take advantage of expensive at the money strikes or whatever, it is that we're doing here to get this theoretical edge, which is a little bit more complex than picking a direction. So I think you do a directional trade and then you say, I don't want to spend that much money. I'm going to see if a butterfly makes sense here. So, but having the butterfly in your toolkit means you can do that, right?
While you're on this page, D, there's a question from RC. He's asking, does the best theoretical edge usually have the best win rate?
No, not always, because the theoretical edge is looking at what the expected value of an option is, not necessarily the best win rate. So I'll give you an example. And I kind of like fall back to this example. Like if I had a wheel, I was spinning a wheel, right? And there are 10 numbers on the wheel, and any number from 1 to 9 landed, and I paid you $1, right? Well, you have a 90% win rate, right? Any number, 1, 2, 3, 4, 5, I paid you $1, that's a 90% win rate. But if it lands on the number 10, you pay me $1,000, right? Well, your win rate is 90%, but you have a negative expected return, right? Because once that hits, that 10% of the time that it hits, right, you're paying me $10,000, 10% of the time to make $1 90% of the time. So the win rate and the theoretical value, they're both important, but no, they're not necessarily like you have to have a high win rate and a high theoretical edge, because remember, one is looking at the expected value versus the market. The other one is looking at, the probability, the frequency of profit. Does that make sense?
Very much so.
And another thing that's really great about this is, like, for instance, you talked about looking at theoretical edge, you talked about looking at win rate. You could sort by either of those. Something that might be fun to look at is percent max gain here. So I've been just staring and this is just because I'm looking at this and we're talking. Immediately I see a trade that pops out here, this JP Morgan trade, where your max gain is significantly higher than your max loss potential. That's not the normal situation for for an iron condor here, that it actually is not right on top of it, right? You have a $4 range, which in a bank stock is, is not a bad range at all here. And so, I mean, you look at this and you're like, wow, I could do this trade and I'm not even risking, and so I have a chance to, so, I mean, and if you look at the rest of these, most of these situations, your max loss is greater than your max gain. So that's something that quickly stands out to me is like, you know what, I'm going to look at JP Morgan as a potential Condor candidate because I'm getting a lot of, I mean, you can see the theoretical edge is really high here as well, but I mean, that sort of thing that depending on what you're looking for, you can easily scan. So, I mean, that's why I said, this is it's indispensable as a tool, I think, when you're looking at this stuff.
Right, exactly. You need, right, because even when we were options traders and you're a market maker, we were market makers, we had lots of tools, a lot of tools to help us out because you can't do it otherwise. And that's the
right.
By the way, those little C's that you see next to the expiration, that's if you hover over it, there's like some kind of events, if we pick them up, you just hover over. So it sees if there's any kind of event before that expiration coming up. So, they're having a conference. Obviously, it may or may not move, but at least you're aware of it because somebody says something, at even a conference CEO, the stock can move, right? So just to be aware of any.
So Jay, we're about to bang against an hour. Is there something you want to finish with that you think is super important in this basic butterfly and iron condor strategy?
Just that I think it's a great idea to play around with this stuff, even if you're not necessarily going to start, making trades. I mean, you can start making paper trades if you want, but playing around with something like this and looking at the different changes of, theoretical edge and max gain, max loss, depending on how wide your strikes are. And, this is how you learn, right? I mean, when I was a market maker, I didn't trade iron condors, right? I was a market maker. I traded whatever the market gave me, right? So I didn't start messing around with this stuff and be a position trader till much later, right? So, I had to do the same thing. And even with the experience in options, I had to start messing around and saying, what happens if I change these strikes and I still do that to this day before I'll recommend a trade. I used to have an iron condor service, before I recommend an iron condor, I would look at multiple iterations of it. And I think it's really important to do that, even if you're not ready yet to make a trade, because you can really get a feel for how this stuff works and get a feel for what your risk versus return is. And as Dmitry was saying, it's all about, understanding the probabilities. That is where your edge is knowing what your odds are versus what you're risking. So I think doing stuff like this and going through and looking at the analysis, it may just seem like a page of numbers, but start spending more time on it and you'll see how really valuable it is and how, and how these structures work. And at one point the light bulb will click on and you'll be like, wow, okay, that makes a whole lot of sense. And this is how that starts. Much easier to do it here than in a book, right? Because books, you can't manipulate numbers and stuff like that. It's good to read about it. All right, hey, if you have a book and says this is what an iron condor does, that's nice. It's a good way to get introduced to it. But this is where you actually see practically how it works. So that's, that's all I have. I'm open for questions for all of us.
We do. Sebastian is asking, why are you using Market Chameleon when you have a Thinkorswim account? He wants to know what about Market Chameleon drives you to it.
That's good. I mean, Thinkorswim is my execution platform. So, I mean, honestly, that's pretty much what I use it for. I really don't do any analysis in there. I mean, there are some risk management features in Thinkorswim that I like to look at. But frankly, if I could execute my trades in Market Chameleon, I probably wouldn't be using Thinkorswim, right? So I think that, Market Chameleon, and I'm not just saying this because Dmitry and Will are here. I was using this before I ever met them, right? It's easier to use. They're constantly adding features, there's stuff in here that you can't see anywhere else. I mean, this was the case. I was amazed by this. Investors Alley contacted Market Chameleon, right? Originally say, hey, you guys want to talk about working together? I mean, because I told the guys when I got hired by Investors Alley, this is the tool I use. You should check it out, right? So, I mean, it's just, I mean, for me, it fits. I'm not saying, Thinkorswim, some people, swear by it, and there's nothing wrong by it. It's a great product, but for me, everything is a lot more intuitive here. I just really like how everything's laid out. You can hover over stuff. You can, everything is right at your fingertips. You want to look at analysis and past perform. I mean, it's just all right there. And, I'm amazed because every time I open it up, I feel like you guys have added something new to this, and I can't wait to mess around with it and see what it does. So.
Well, that's Dmitry right there. He's always, there are so many ideas in that head of his. It's incredible. Always something.
Well, and the difference is we're not an execution platform. We're a research platform. That's what we focus on. So we're always looking, talking to customers. So the benefit is that we have, lots of people using with good ideas that things are working that we'll put in there, but we concentrate on the research, not on the execution, right? There's an execution platform. They have to concentrate on the execution as well for Thinkorswim because they have to sell order flow, right? To somebody.
Well, that's another topic. It is now 9 o'clock.
Yeah,
and I'm about to go to Market Chameleon headquarters to have a nice relaxing beverage with Dmitry there. Jay, thanks for doing this with us. It was awesome. Super.
Yeah. Thank you, Jay. Thank you, everybody, for joining us tonight. Here it's 9 p.m. on the Eastern Coast. So,
Jay, what's it, 7 o'clock for you there, Jay?
Yeah, no, 6 o'clock. Only 6 o'clock here. So
6 o'clock for Jay.
Yeah, so it's still early.
Unless, Jay, did you want to answer a few more? Or
I can answer some more. And we had, I'm going to say I have.
Where do you get the coffee mugs, Will?
Where do you get the coffee? I had also coffee. We mentioned coffee and Condors earlier. It's kind of like a chat room. I know Will has been to it. That's where, we were just looking at some broken wing butterfly trades the other day. It's kind of just an open forum, kind of like this, where I'll talk about the market. We'll talk about, we'll talk about some trade strategies, and it's meant to be interactive. I do that twice a week. So, coffeeandcondors.com, I think, right? Or do you have a link? Will, I think you had a link for that, maybe potentially. I don't know. Maybe not.
I don't have a link. Sorry about that.
Okay. All right. So, anyways, we'll, next time we'll grab a link for you. But anyways.
Well, I'm going to, everyone who registered, I'm going to get the information and we will send out a copy of this video. We'll send a link to Jay's stuff and good stuff.
All right. Thanks, everyone. Have a good night. Stay safe.
I'm off to the beach.
Yeah. Thank you very much.
I do appreciate everyone showing, and we're gonna have Jay on in towards the end of July, and we'll dig deeper into butterflies and iron condors.
Absolutely.
All right, everybody.
Thank you.
Good night.
Bye bye.